Hey there. Welcome to Self Employed Mortgage Myths. So, today we are going to discuss all fun things about mortgages and being self employed. Why? Because I am really sad when I talk to self employed people and they feel like they don't have options. And they often do. They're just not asking the right questions or not talking to the right people. Okay, so who am I? Why are you listening to me? Well, I'm Denise Laframboise of laframboisemortgage.ca. And this is my 10th year in the mortgage industry. I work with over 60 different lenders. I am an Amazon best-selling co-author on a book for entrepreneurs about self-employed mortgages. We work as an all-female team built on honesty here, not just closing deals. And self-employed financing is my specialty. Okay, not a side focus, not something else I do. This is really the bread and butter of everything we do every day. There's also a QR code there. I always forget to give this, so I thought I'd put it right in the front of the presentation today. If you want to download that, that is our app. So it shows you accurate information about interest rates, closing cost calculators. There's different calculators you can play with, which I'm going to show you some things about A lending versus B lending, and is going to make your wheels turn if you're watching this and you're self-employed. So that is going to be a super fun tool for you if you want to check it out there, or you can grab it at our website at any time at laframboisemortgage.ca. So why why is self-employed so important? Well, I want you to understand that 1 in 6 Canadians is self-employed, right? So that means that on average, the people that we're going to come in contact with, often at least one of the people in each family is self-employed. Okay, we work with 60 different lenders. And something that is really interesting is that people think that we do a lot of B mortgages, and we do, but 90% of our files year to date this year have been approved with A lenders. A lot of them are specialty products, which we're going to talk about a bit, or just really taking the time to really present how the income looks so that we can offset risk to lenders. But it is often the case that we are able to get things done with A lenders that people don't think are possible. Okay. So let's jump into some myths here. So, myth number one: sole proprietors and incorporated owners qualify the same way. So, this is not true. When we are self employed and we're sole proprietor or part of a partnership, we own that business. It's really clear we own the business, we own the income. It's all ours, right? It belongs to whoever owns that business. And so, how the income looks, so for most lenders, what they will do is they will take the net income and then they can potentially add in write offs, right? So if you write off things like a home office or some meals, we can potentially add those back in and use that like net number plus some additional write off money back in to qualify you for the stress test. Okay. When we're incorporated, it's like we draw a line in the sand and say, you know what? That money is the corporation's money, not mine, right? We do this because the corporation's money is taxed differently, right? That's why I do it. That's why I'm incorporated, because that money is a different tax rate than my personal tax rate. But for a lot of A lenders, then what happens is they look at um, your income differently. Now, instead of saying, okay, yeah, you obviously own this whole business, many lenders will look at it and say, what did you get paid for the last 2 years in a row from that business, either in dividends or commission or like T4 income from your corporation? They may not look at the corporation as a whole and say, wait a minute, you own that. Now, other lenders do this, and this is what we're going to get into, right? The money inside your corporation can never be used to qualify, right? This is a myth. This is also untrue. We have lenders who will look at the whole picture and say, okay, yeah, I know for tax purposes, you said that that's a corpse money, not yours. But when we look at the articles of incorporation, you own that. Because you own it, we will take a look at the income inside of it. Or sometimes they will take a look at the retained earnings or the net income after taxes inside the corporation and add a certain percentage of it into your income for qualifying purposes. So this is where sometimes and actually we have one A lender that will allow us to put write-offs, put write-offs from the corporation back into your personal income without having the tax consequence to do that to allow you to qualify higher on the stress test. So very, very cool when we know what each lender can do, we know how to use it to our advantage, right? And these are really, they're all specialized programs for self-employed people because the reality is, if you are self employed and you have really good credit and you have a profitable business, you do have options, right? If you're making money, you do have options. But someone needs to look at your T1s, your T2s, maybe your bank statements and invoices and be able to really understand how your income works, right? And this is where I stress a lot, like there's a little note at the bottom. For incorporated clients, this is why picking the right lender matters. And this is why we have so many situations where people come and say, well, my bank said I couldn't do that. And then we're either able to do it at their own bank or at a different bank across the street because they just, their income fits a different specialty product than what the bank that they asked has, right? Myth number three, everyone can benefit from a collateral charge. So, if you don't know what a collateral charge is, it's essentially that you charge the title of the house and register the mortgage up to 125% of the property value, right? So it is common for most of our banks to do this. And I am not here to tell you if it's good or bad. But what I want to tell you is the things that self employed people need to understand about this. Okay. So it can be helpful. If we are registering for 125 percentage of the property value at some point in the future, if you need to add a line of credit, if you need to access more funds, if you need to increase your mortgage amount, it can save you money. There are times where we can do a restructure inside a collateral charge and it costs the client nothing because the title charge is already there for that lender to be able to lend credit products to that client up to that certain amount as long as the property value is there. Okay, so that can be really helpful. That being said, it can also hurt, right? So, a part of what a collateral charge entails, it says that business debts can be leaned against the home if the banking is at the same institution, right? Not just business debts, any debt. So, any debts with a personal guarantee, which we're going to talk about in a second, but anything. So, say you co sign for your kid's car and the kid defaults on those payments, well, that could actually be held against your property by that lender if they're at the same place, right? And so this is something that we catch in the paperwork for clients a lot that most people have no idea to ask about. Okay. And even though they can help for business owners who bank personally and commercially at the same institution, it can be very concerning. And so this is why we review. And one of the first questions we talk to every client about is where is your business banking? And is it a concern for your personal home to be at the same place? Okay. Business debts are not part of your personal stress test. So this is a myth. What is hiding in your paperwork often is a personal guarantee, which is a bit of a hidden trap, right? Um, if a client signs personally on a business debt, it's on their credit bureau sometimes. And so then what can happen is that many clients have no idea they've actually signed this. And then when we pull credit, we find it and it becomes a bit of a surprise that now they qualify for less because something inside the business that they signed for, they didn't realize was going to be held against them on their personal credit bureau. This again is why lender selection matters because sometimes some lenders will accept us to just show them the banking and show them that the business pays this, not you, and they will take it out. Other lenders will require it to be part of your stress test and reduce what you qualify for. Myth, the bank said no, so it's a no everywhere. So we talked about this briefly previously, right? Over 90% of the mortgages we've done this year are with A lenders. Lots of them are for self employed clients. A bank saying no often isn't about the file or the client. It's about maybe the situation, maybe the specific property, right? Sometimes a client will fit in a specialized self employed program, but that lender doesn't have one, right? So it's very, very important to think about a decline is not always a no. It just might not be the right fit. And I always go back to thinking about cars. I have a family of 5, right? I have 3 kids and a dog. Like, we're minivan people. We need a minivan. If I go to a dealership that doesn't have a minivan, Well, they're going to try and sell me a truck or an SUV because they don't have what I'm looking for. But so they're going to try and fit me into something that doesn't fit. But if I walked across the street to a dealership that had a minivan, I'm going to get exactly what I want. And mortgages are kind of the same. For the most part, most lenders do pretty much the same thing, but they all have different nuances and they all have different specialty products and they all have, slightly different rates at slightly different times, right? So sometimes the right fit genuinely is just a different kind of lender, but sometimes it's just a specific um, product, or sometimes it's how we position it, right? Or the extra documentation we might ask you for to prove that this vehicle payment actually comes out of the business, or that you are paying yourself or paying your spouse or something. And so that we can back that income out in order to qualify for more. Okay, so here's something that I wanted to show you, and it's just a basic example of two clients. And I wanted to show you this just because sometimes people don't realize that a B lender is not worse, right? It's not A is good and B is bad. A B lender mortgage is a tool, the same as a private lending tool. And there are times where that tool can help us get somewhere faster, right? Help us get somewhere more efficiently or with more savings. The example I have here is just two incorporated people. And what I really want you to recognize is as we're going down, so let's say Jane and Dave, and we're saying they both earn $200,000 a year, but Jane is incorporated and told her accountant to save her the most money possible on tax, right? Because that's their job. And Dave is a sole proprietor and he's just doing his thing and paying the government what they ask for every single year. And he really hasn't thought about incorporating. He's just working through the motions here. Okay, so Jane, let's say her income tax bill in a year is about $22,000. Note that I did not do these calculations. I had a lovely accountant do them for me because I do not give accounting advice. Okay. But let's say she paid $22,000 to be able to qualify for this mortgage, right? Based on what she was doing with her income and that she has this accountant saving her the most money possible. Dave, with the same income, is a sole proprietor. He's not set up to be as tax advantageous as Jane is. And as a result, he's paying $50,000, 50,300 in tax, in income tax. But he wants to qualify for a minimum down payment mortgage. So, in order to do that, like the 5% down mortgages or the minimum, say, MHCs, he needs to actually have consistent income for 2 years in a row on his tax documents, which means he actually needs to pay $50,000 for 2 years in a row in income tax to be able to qualify for this. And so when we look at that, whose income tax bill would you rather pay? I'd rather pay Jane's. I'm sure you're with me. Now, when we look at the minimum down payment, if Jane wants to buy a house, she's going to need at least 20% down in a marketable area. If she's looking somewhere super rural or super unique, she might even need more. But Dave only needs 5% down. The down payment on a $700,000 home, Jane's would be 140,000 and Dave's would only be 45,000. So how much do they qualify for? Well, if we're looking at B lenders for Jane, she's going to qualify for $900,000 in mortgage money. Dave, on the other hand, is stuck with these 5% down minimum down payment guidelines. He has to meet both the lender and the insurer's requirements. So he's only going to qualify for $750,000. And this is going to be 2 to 3 years that he needs to wait to do this. So the reason for that is he needs 2 full tax years of tax documents, right? So if his business started in a partial year, he might need to wait like 2.5 years to be able to have 2 full years of tax documents. Jane can buy in as little as 6 months with 6 months or 12 months of business bank statements showing that she's making a lot of money. So if they both got a $700,000 mortgage, what would this actually cost? Well, if we looked at setup fees, Jane's going to have setup fees, so lender fees and broker fees of $10,500. So she's going to be out some extra money here. And Dave has no setup fees. He's going to qualify with every lender, every bank, credit union, and monoline we have. Jane is going to have an interest rate today 5.24, right? Let's assume she has great credit. Dave also has good credit. His interest rate today would be 4.24. And let's say that Jane, we're being conservative on both of them. Let's say Jane wanted to do a 30-year amortization, although with B lending, we have some 35 and some 40-year options, which can make the payments even lower. And Dave is going to do 25 years, although if he's a first time buyer, he would have the option of 30 years to make those payments a bit lower. But I wanted to give you kind of a standard example. This is typical what most people will take. And then Jane will have no default insurance costs. Dave's default insurance costs will be $28,000. So I want you to think about that for a second because a lot of people want to avoid B lending because there's setup fees and they don't really always think about the setup fees of the insurance on an under 20% down mortgage. It's actually more than double what the setup fees would be for the B. So it's just something to keep in mind that there's fees everywhere, but some of them cost you a lot more. And because these get wrapped into the mortgage, we don't always see them. And in terms of today, if we looked at these scenarios, their monthly payments, Jane's, even though her interest rate is higher because her amortization is a bit lower, her payments would actually be slightly lower than Dave's on a month to month basis. And so I show you this because I want you to be very clear that neither path is right or wrong. And it depends entirely on what the client needs, what their tax saving is, what their qualifying power is, what their timeline is, and what rate do they want. But when we are self employed people, we need to look at global savings. Right? Global savings is very, very important. And what I mean by that is it's not just about how much we're saving on the rate or on the setup fees or on the default insurance. It's also what are we saving in income tax? Because I'm telling you right now, given this scenario, given this example, I would choose to be Jane every time. I would take a B lender all day, every day. And the reason for that is because I don't want to pay $100,000 in income tax when I could pay 22 and get something similar. And so this is the difference. And especially when we're self-employed, and I think about we don't have pensions. We don't have pensions. So typically, what I suggest is you have a couple houses, you have a couple investment properties, and that will be your pension. Right. And when we do that, well, if we're going to qualify for more rental properties or we're going to have them be cash flow positive at all times, then we are going to potentially want to look at qualifying for more on B lending, stretching out amortization on B lending. That these can be really great tools to help us get two properties instead of one. So it's just something for you to think about. And these are the everyday scenarios we do with clients all the time. So when you meet a self employed person, send them to me. I would love to talk. I would love to give them some advice, real options, and really give them some numbers to consider about what they can actually do because there's too many people out there being told that they can't do something and they actually can. So I want to thank you for joining me today. And I hope you learned something. And our office is right here in the center of Brooklyn at 289 645 1568. And we do help clients across the province. So, anyone in Ontario, we can assist. If you have any questions, let us know. Thanks.